Ladies and gentlemen, imagine waking up tomorrow and discovering that the money you've spent decades saving has quietly become less valuable, not because you spent it, not because the stock market crashed, but because confidence itself began to change. Not confidence in a company, not confidence in a bank, confidence in the system that supports the world's most important currency. Over the past several months, a growing public dispute between President Trump and the Federal Reserve has become one of the most closely watched stories in global finance. For many people, it sounds like another political argument. But to professional investors, it represents something much larger. It raises difficult questions about interest rates, inflation, government debt, and the long-term credibility of America's financial institutions. Tonight, we're going to separate headlines from economics. We'll explore why this debate has captured the attention of Wall Street, why some investors are watching the bond market more closely than the stock market, and why many central banks continue adding gold to their reserves despite short-term price swings. Most importantly, we'll examine what all of this could mean for your savings, not through fear but through understanding. Because in financial history, the biggest risks are often the ones that develop quietly, long before they dominate the front page. Let's begin why this fight matters beyond politics. Every generation experiences moments when economics and politics collide. Sometimes those moments pass quickly. Sometimes they reshape financial markets for years. The current debate surrounding the Federal Reserve has become one of those moments. To understand why, we first need to understand the Fed's role. The Federal Reserve isn't simply another government office. Its primary responsibility is to help maintain stable prices, support employment, and promote financial stability by adjusting monetary policy. One of its most powerful tools is interest rates. When inflation rises too quickly, the Fed may keep rates higher to slow spending and reduce price pressures. When economic activity weakens significantly, it may lower rates to encourage borrowing and investment. Those decisions affect almost everything. Mortgage rates, business loans, credit cards, retirement accounts, bond prices, even the value of the US dollar. That is why investors closely watch not only what the Federal Reserve does, but also whether markets believe it can make those decisions independently. Recent public disagreements between President Trump and Federal Reserve leadership have drawn attention because they raise broader questions about future monetary policy. Regardless of anyone's political views, financial markets tend to react whenever uncertainty increases around major institutions. Markets don't like uncertainty. They try to price it immediately. Why investors watch bonds before headlines. When people hear the word market, they usually think about stocks. But many professional investors spend just as much time watching government bonds. Why? Because the bond market often reflects expectations about inflation, economic growth, and future interest rates. When investors demand higher returns to lend money, bond yields rise. When demand for bonds increases, yields generally move lower. These changes can influence borrowing costs throughout the entire economy. For retirees, bond performance matters because pension funds, insurance companies, and many diversified investment portfolios hold significant amounts of government debt. If investors begin changing their expectations about inflation or future policy, bond prices can respond long before those changes appear in everyday news coverage. This is one reason economists often describe the bond market as a window into investor expectations. It doesn't predict the future perfectly. Nothing does. But it reveals how millions of participants collectively evaluate risk. Recently, attention has focused on whether future interest rates could remain elevated longer than expected or eventually decline if economic conditions soften. Those changing expectations have become one of the biggest forces influencing both bond prices and precious metals. Why gold keeps returning to the conversation. Whenever uncertainty grows, one question returns again and again. Why do investors keep talking about gold? The answer isn't because gold always rises. It doesn't. Gold has experienced long periods of both strength and weakness throughout history. Instead, many investors view gold differently from traditional financial assets. Unlike paper currencies, gold cannot be created through monetary policy. Unlike corporate earnings, its value isn't tied to the success of a single business. Unlike government bonds, it doesn't depend on future repayment. That unique role explains why central banks across multiple regions have continued increasing their gold reserves in recent years. Each country has different reasons. Some seek diversification. Others want additional resilience within their reserve portfolios. Others simply aim to reduce concentration in any single asset class. Professional investors pay attention to these developments because central bank decisions often reflect long-term strategic thinking rather than short-term market sentiment. At the same time, higher interest rates can place pressure on gold because income-producing assets become relatively more attractive. This creates a constant balance. On one side are concerns about inflation, debt, and geopolitical uncertainty. On the other side are higher yields and a stronger dollar. That balance helps explain why gold prices sometimes move differently than many people expect. Understanding those competing forces is far more useful than reacting to a single day's price movement. Because successful long-term investing isn't about predicting every headline. It's about understanding the larger economic trends developing beneath them. And those trends may tell us far more about the future than today's market noise ever could. Coming up, we'll examine how confidence in the US dollar influences global markets, why economists disagree about gold's outlook, and the 3 possible paths investors are watching most closely over the months ahead, why gold is rising while confidence is falling. Now let me connect all of this to the one asset that has survived every political crisis, every debt crisis, every currency crisis, and every financial experiment in recorded history. Gold. People often think gold rises because investors become excited. History tells a different story. Gold usually rises because confidence falls. When investors completely trust governments, they happily own paper assets. When they trust central banks, they own bonds. When they trust corporations, they own stocks. But when trust itself begins to weaken, they slowly begin asking a different question. What happens if the promises stop working? That is exactly the question many institutional investors are quietly asking today. The issue is not simply whether President Trump is criticizing the Federal Reserve. Presidents have disagreed with the Fed before. The issue is whether global investors begin believing that monetary policy is becoming political rather than independent. Because once confidence starts disappearing, money starts looking for neutrality. Gold doesn't need Congress. Gold doesn't vote. Gold has no earnings report. No CEO. No chairman. No political campaign. It simply exists. That is why, for thousands of years, civilizations have repeatedly returned to gold whenever confidence in paper systems weakened. Notice something interesting. During periods of uncertainty, people rarely rush toward what promises the highest return. They rush toward what they believe will still exist years later. That difference matters. Because wealth preservation and wealth creation are 2 completely different games. Wall Street often focuses on creating wealth. Central banks focus on preserving it. And lately, their actions have been speaking much louder than their speeches. This is why so many countries continue increasing their gold reserves despite record prices. They're not buying because gold is fashionable. They're buying because uncertainty itself has become valuable. The other side of the story. Now, I promised you honesty. And honesty requires telling you something many videos conveniently ignore. Not everyone believes gold is destined to soar. Some respected economists believe inflation will continue cooling. Others argue technological innovation could keep productivity rising. Some believe the Federal Reserve will successfully control inflation without causing a major recession. If that happens, interest rates may stay relatively high. The dollar could remain stronger than many expect. And gold might spend months, perhaps even years, moving sideways instead of exploding higher. That possibility absolutely exists. Markets rarely move in straight lines. They never reward certainty. That is why experienced investors never confuse a long-term trend with short-term price movements. Gold has experienced painful corrections before. Sometimes 20%. Sometimes even more. During those moments, headlines become frightening. Television declares the rally finished. Analysts suddenly discover dozens of reasons why gold failed. Yet history shows something fascinating. The biggest long-term bull markets often contain some of the scariest short-term declines. The impatient sell. The disciplined observe. The institutions quietly rebalance. That difference explains why many retail investors buy emotionally and sell emotionally. Professional investors attempt to do the opposite. This isn't about predicting tomorrow's price. It's about understanding the forces underneath tomorrow's headlines. Because headlines change every day. Debt trends don't. Demographics don't. Government borrowing doesn't. Global reserve management doesn't. These are slow-moving forces. And slow-moving forces often create the biggest investment trends. So, where does all this lead? No one knows with certainty. But there are 3 realistic paths investors should consider. Scenario 1, the Fed holds firm. If inflation remains stubborn, the Federal Reserve may keep interest rates elevated longer than expected. That would likely continue putting pressure on gold in the short term. Prices could remain volatile. Markets could become frustrated. Many impatient investors could lose confidence. Scenario 2, the Fed eventually cuts rates. If economic growth slows, or unemployment rises, the Federal Reserve could eventually begin lowering interest rates. Historically, lower rates reduce the opportunity cost of holding gold. The dollar may weaken, liquidity could increase, and precious metals often respond positively under those conditions. This is the scenario many major investment banks appear to be preparing for, not because they know the future, but because they understand probabilities. Scenario 3, confidence changes everything. The third possibility is the one that receives the least attention. Suppose markets begin losing confidence not because of inflation, but because they simply stop believing governments can solve ever-growing debt without creating more money. That changes everything. Because confidence, once lost, is incredibly difficult to rebuild. History has shown this repeatedly. Currencies recover, economies recover, but trust takes much longer. And when investors begin protecting trust instead of chasing returns, gold often becomes one of the first places they look tonight. Millions of Americans will watch political arguments. They'll hear speeches. They'll read headlines. Most will believe this story is about politics. But underneath those headlines, money is making decisions. Pension funds are making decisions. Central banks are making decisions. Institutional investors are making decisions. They are not asking who wins the next election. They're asking, what protects purchasing power over the next decade? That question may become one of the most important financial questions of this generation. Whether gold reaches new highs, whether the dollar strengthens, or whether markets surprise everyone once again, only time will answer. But understanding why money moves is always more valuable than reacting after it already has. Because ordinary investors chase headlines. Prepared investors study incentives. And history has often rewarded the people who understood the system before the crowd finally noticed it. If today's discussion helped you see the connection between politics, the Federal Reserve, the US dollar, and your own savings in a clearer way, let me know your thoughts in the comments. Do you believe the Federal Reserve should remain completely independent, or do you think elected leaders should have more influence over interest rate decisions? I'd genuinely like to hear your perspective. And if you enjoy calm, fact-based explanations about gold, silver, inflation, central banks, and the forces shaping the global economy, subscribe and turn on notifications. Because the next major economic headline won't just affect Wall Street. It could affect every dollar you save, every investment you own, and every financial decision you make in the years ahead.